Hello, welcome back. We're almost at the end of day 3 at Beaver Creek, and I'm with Alexander Scanlon, the MD and CEO at Barton Gold. Alex, good to see you.
Good to see you as well.
Look, it's been actually quite a while since you've been back on the channel, so why don't we do a bit of a refresh? Why don't you tell the audience who you are, what you're up to, and then we'll dive in after that.
Yeah, look, over the past 16 months, we've made pretty strong headway into sort of validating our geological theses for a really large regional gold development. So, very high level, who we are and what we do is we are a pure play gold developer in the central Gawler Craton of South Australia. So this is where BHP has its IOCG province. The same basin becomes shallower and more goldy as it moves to the west. And we've consolidated every significant historical exploration and producing asset in that area, including the only gold mill. So our strategy has been to build up a much larger resource base and then turn on the whole region in a staged, lower cost, lower risk development model. Now anchored around large scale, long-term, super efficient production, but leveraging our existing infrastructure so that we can start a small scale operation, re-rate our equity, re-rate our credit, and also fund our own expansion.
Okay, good. Okay, you're talking about equity and credit and whatnot. Why don't we just talk up a little bit about the cap structure as it stands, and then we'll talk a bit more.
So we have about 220 million shares outstanding. Our market capitalization is about 50 million Australian. About 37 and change from a US dollar perspective. We have $10 million Australian in cash, so 40 million Australian enterprise value, low 30s in US dollar terms. No debt. Our options are related to performance options that are long term, so that's a basically incentivization for our entire team. And really we continue doing what we're good at doing, which is while we are a net consumer of capital, we consume a lot less from inbound investors because we actually generate capital internally.
Yeah.
So we actually just sold recently about $4.5 million worth of gold. We continue monetizing some assets we have on site. So it puts us in a pretty strong position in terms of capital structure. Human capital, very important as well. We've now got a team that has about 300 years of experience exploring for, permitting, building, financing, operating, and optimizing major assets. With a very strong pedigree in gold. Half of our leadership team are from Normandy and Newmont Mining, and a very strong pedigree in South Australia. That's where everybody is, and most of our team are sort of lifelong diehard South Australians. So that gives us a very strong identity, which puts us in good stead with the government as well.
Good. Okay. Look, well, we spoke, like I said, quite a while back. You're exploring, you're finding. Obviously, you have all the existing infrastructure. We can go into that and what that means, and then the material that you were exploring for, I think you got up to around 1 million ounces. I think when we last spoke, was that right?
Correct, yeah.
So what's happened in terms of what's happened with the drill bit since we've last spoken? Because that's, I think, where really the real value is usually added, right?
Yeah, so we did 2 major growth programs. We actually accelerated some work that we were going to do this year into last year. So we did about close to 50,000 meters worth of drilling. Our Tonkilia project, which is that large-scale shear-hosted deposit that we anticipated or hoped would become an anchor for the long term. We grew that from 965,000 ounces to 1.1 and then 1.3 and 1.5 million ounces. So that 1.5 million ounces, we delivered that on the 4th of March this year. And then by July, we'd already put out a very advanced scoping study demonstrating that fixed to the assumption of operating at scale. So we sort of fixed the equation around 5 million ton per annum. What it does is it produces 130,000 ounces per annum of gold at an average all-in sustaining cost of $1,900 Australian, or about $12.50 US per ounce. In the Australian context, that means that we would be a sort of bottom of the second quartile producer. If we were operating today, we'd be ranked number sort of 17 to 47. But there's obviously some inefficiency we left in those official numbers, or the original numbers. We have the ability to bring in our power costs, our power consumption, increase the efficiency and comminution. So what we're looking at doing now is bringing in some of those savings, pushing it into the mine design, further optimizing everything, and we'll probably end up with something that's a 4 to 4.5 million ton per annum plant, running for 8 to 10 years, producing something like 120,000 ounces per annum. Very much exactly the follow the leader methodology we've been talking about in terms of replicating the success of the Capricorn, Karlawinda, and Mount Gibson model.
Okay, interesting. So I'm just trying to get my head around what the future looks like, because obviously you got this existing infrastructure and you have been able to, I think when we last spoke, you were running through some of the residual gold in the plant, and you'll be able to sell some of that on, and so you haven't had to call on as much capital as, say, other companies would have done to be in your position.
Correct.
Is there still a chance for you to still utilize that infrastructure to continue generating revenue?
Yeah, so the gold that we've sold has actually been very small ad hoc production. So we've sold probably in total 13 tons of high-grade concentrates. But that was really a function of sort of cleaning out the mill and other sort of small stockpiles to get ready to re-optimize or refurbish that mill for operations. So in parallel with growing Tunkillia, the neighboring Tarcoola goldfield, that's actually the home of high-grade gold in South Australia. That is where South Australia had its gold rush in 1893, and there's sort of a 130-year history of high-grade gold production there. There was a mining lease put in place in 2016, and 2017 and 2018, an open pit there, quite small, 400 meters long and 30 to 60 meters deep, produced about 50,000 ounces of gold to our mill. So we know how the material works in our mill. The logistics are very simple, no cost. What we've done is we've gone and put about 20,000 ounces in the pit floor. So this is from the pit floor to maximum 60 meters depth. We've done some more follow-up drilling, so we think we'll add more ounces to that. And the only thing we need to do there is create 40 to 60,000 ounces between that pit and some of the other existing stockpiles we have and other little high-grade bits to underwrite the restart of that mill. So if we look forward, where do we want to be in a year's time when we're talking again? I want to have crystallized Tunkillia as an absolute no-brainer, first quartile producer in the making, and I want to have crystallized the Tarcoola story between easily shallow, easily accessible shallow open pit mineralization going through our mill, and put that on the track to development and operations, because it's a very short step to get that operating, and then we can just produce 20 or 25,000 ounces per annum for several years while we're building Tunkillia, and then jump up to 150,000 ounces. It's much lower cost, it's much lower risk, equity transition, credit transition, but also cultural transition. Going from zero to hero is very difficult culturally. If you can just turn on an existing pit, an existing mill using contract operators, you can retrain your entire culture around a culture of operations. And then the big project is an expansion, not a reimagination of who you are.
Okay, and how would that look as an expansion? Because I'd imagine, obviously, with a lower grade ore body, you'd need to really ramp up the throughput, right?
Correct. So we would be building a new large-scale mill immediately adjacent to that ore body.
Okay.
So we have modeled that as a 5 million ton per annum mill, and we sort of, to test the equation, so how does this solve around scale, we sort of fixed the mill at 5 million ton per annum, and we fixed the mine plan at 5 million ton per annum. Now, really, when you optimize, you need to let these things fluctuate. And what will happen in practice is you'll have a mill that's probably rated to 4 or 4.5 million ton per annum for fresh material. With softer material, of course, it goes through faster, so it might run at 5 million ton per annum. That also leaves some spare capacity for us to blend in higher grade ore from Tarcoola.
Okay, interesting.
But that would be a large scale mill, anywhere from 1 to 3 stage crushing, 2 ball mills. And what we're looking for is volumetric efficiencies of capital and operating costs, both in terms of the size of the shovels and how much you can get through that mill very efficiently. So the difference between a 4 to 5 million ton per annum plant and our current 600,000 ton per annum plant is that 600,000 ton per annum plant is pretty efficient relative to its competitors, but it costs about $40 per ton to process, $40 to process 1 ton of material. The 4.5 to 5 million ton per annum plant can do that at more like 15 to 25, depending upon the hardness of the material. So it's much, much more efficient. And of course, you want that right next to that bulk open pit.
Yeah, okay, that makes a lot of sense. In the scoping, did you envision or include this sort of ramp up of the existing infrastructure? Was that actually in the, or is this more of a new idea?
The study was completely standalone on the Tunkillia project. So we haven't yet added kind of any of the benefits of having that step ladder to climb over that wall. We're going to sort of crystallize those stories independently, sort of understand their economics independently.
Okay, that's good.
And in reality, they bolt together because Tarcoola and Tunkillia are 45 miles apart, so they're really one project. We just have the ability to send ore from Tarcoola to the existing mill. So we'll identify those independently, and it'll give people the understanding of exactly what the economics are of that and how that feeds the economics of this.
Okay. In terms of, obviously you were talking about producing around 20,000 to begin with for a couple of years. And I think you did mention that. I think you've already found 20,000, haven't you? And you're doing a bit more drilling now. So at what point does the underground or the higher grade underground stuff, I guess once you've built this new mill, then you don't really need to continue looking for the higher grade stuff, will you? Because
well, we will. So there's a lot of economic torque in a mill of scale. So what's really interesting, if you look at the outputs from our scoping study, on average, the throughput grade in that going to the mill at 5 million ton per annum is 0.93 gram per ton. And that's producing gold at a cash cost of 1875 Australian. In the starter pit, we've got a higher grade starter pit, the high grade sort of central zone. The average grade is only 1.25, so it's increased 30%. But the cash cost drops to 1,250 Australian, so about 800 US. And what that reflects is simply a greater denominator, a greater dividing number in terms of number of ounces that you're producing with that higher grade with a fixed throughput. So we have that very attractive first year of operations where we're producing 180,000 ounces and getting around $400 million in gross free cash flow. So that is why, even though this is just an initial test, we have essentially 1 year payback on the infrastructure cost. Therefore, we want just a little bit of this further high-grade mineralization from Tarcoola that we can just sprinkle in as a high-grade satellite.
Yeah. No, that makes sense. Okay, well, look, talk to me about, you're talking about crystallizing these plans, and obviously you've got some drilling going on. I think we were talking earlier, you've got 20,000 meters of drilling planned as well.
Correct.
What's the priority with that? Is that more focused towards the high-grade resources or ounces that you're looking for? Or is this more the open pit and trying to really do the resource confirmation?
It's probably four different things. Okay. So one, further optimization of the resource at Tonkilia. We want to smooth the profile of that basically on the sides and the base as much as possible. The smoother the size and the smoother the pit shape, the more efficient it is both in capital and operating costs. We're also now moving out along that shear. So the sandbox that we've been playing in with that project is very small. We're on sort of 5 kilometers of about 30 kilometers of shear, and actually both sides of it are mineralized. So we're going to start stepping out in some of the areas that we would think would be most economically attractive if we made another discovery right along strike. We are also going to be doing some further drilling around Tarcoola in the existing pit, but we've also identified a new gold discovery about 3 kilometers west of that pit. So that's more high-grade mineralization that can go through Tonkilia. We're also going to be testing a large regional shear zone around Tarcoola and doing some further drilling up near our plant. So it's a combination of optimize the big platform, accelerate the smaller platform, and continue in the periphery to be doing that regionally generative work. Because if we find these large-scale zones of alteration that are mineralized, we are already demonstrating a commercial platform onto which those can attach. That alteration, that mineralization, is immediately far more valuable than alteration that does not have a platform to bolt onto.
Yep.
So it's really kind of a multifaceted stage strategy. We've now built the core, now we're building towards the present, and we'll build out.
Yeah, nice, okay. At what point, I guess it depends what your outcomes are, but at what point do you need to really just now start switching your pivot or focus onto really developing the mine versus exploration, right? Because at some point you get enough scale just for the first 10, 15 years, and it's,
yeah,
you have to have that toss-up between, do you carry on exploring or do you just really go gung-ho on building the thing?
Yeah, so in a manner of speaking, when we think about Tonkilia and optimizing that, what we're really trying to do is establish years 5 through 15 for the company. With Tarcoola, that smaller but high-grade gold field, and our existing mill, we're building backwards from year 5 to 2.
Yep, okay.
So those two things together are kind of that 15-year track. But that said, if you're creating the optionality around and actually adding more mineralization, and you never know if that mineralization might be higher grade or lower grade, there's a substitution effect that can be immensely valuable even if you're living just inside that 15-year horizon.
Yeah.
But there's also a scaling option, right? So plants are scalable if you have the right front end. You can add additional tanks. So if you found some, another 10 kilometers of mineralized alteration along strike, you'd have the ability, before you've actually gone and built this plant, to actually scale appropriately. So it's good to get that information before you actually cast things in stone, so to speak.
Yeah.
And you always want to be generating that sort of exploration pipeline as well, and in creating that next 5 and 10 years of optionality for the company.
Okay. So would it be fair to say then that this recent scoping study is really more just a a pin in time, and really what you want to be demonstrating down the line for yourselves and your shareholders is really a much larger organisation that can produce potentially 250,000 ounces a year.
Yeah, I mean, our ambition, I suppose you would say, our hope is that, we've demonstrated our theory that the shear zone that hosts Tonkilia, that the system or systems that are there actually have a much greater gold endowment than was historically recognized. Now, if that plays out along the shear, then we could have a sort of series of bulk open pits. It could be basically a district that we control. And then if you have that sort of series of bulk open pits, again, you're going to really want to emphasize some nearby satellite high-grade material. So it actually gives you even more reason to look at Tarcoola and just keep building these things in tandem.
Okay. Look, I know you can't say too much because you haven't done the economics on the higher grade portion and the existing infrastructure, but in terms of timing and potentially, I don't know if you're able to give us any indication of CapEx in terms of getting this back up and running and what the timing could be until you're really generating 20,000 ounces a year.
Yeah.
What does that look like? So,
in terms of the mill, the mill that we have there was running from 2002 to 2018. It's a very basic mill, which is kind of one of its blessings. The really complicated mills are the ones that you really have to spend a lot of money refurbishing. It was also running at about 600,000 ton per annum. We're probably going to derate the mill, right? So we'll use fewer tanks, simpler front end, make sure that it's running really efficiently but full. You're right, we haven't published a number, but it's not going to cost a lot of money in our estimation to get that mill refurbished as we want it.
Yep.
The open pit that's there at Tarcoola is essentially a walk-up, zero pre-strip restart, and we'll be using a contractor to do that. So we'll keep the working capital requirements quite lean. And in terms of timing, we don't need a lot to be able to look forward and say, today we elect to push the button. Because obviously these things need to unfold with adequate timing, so you don't try to crawl to a sprint because you land on your face. But looking forward 9 months, what I'd like to be able to do is 9 or 12 months be sitting here saying, look, we've crystallized those 60,000 to 80,000 ounces that are going to underwrite a 3-year initial operation. Yep. And now we're looking forward to starting this in the middle of 2026, and then we've got a 5-year growth trajectory through to our target.
Okay, that makes a lot of sense. Okay, good. Alex, thank you very much for your time.
Thank you very much.
Cheers.